I'm Joe Craig, Interim Director of the UCCS Economic Forum, and welcome to the weekly Economic Snapshot. I'm here with Brendan Zahl. Brendan, would you introduce yourself?
Yeah, good morning, Joe, and good morning, everyone. I'm president of Community Banks of Colorado and live here in the Pikes Peak region and have since 1998. I've been in banking since 1998 as well, and joined Community Banks of Colorado in 2007. So good morning and excited to be here. Thanks, Joe.
Thanks for being here. So tell us a little bit about Community Banks of Colorado and what do you see as your major role in our community?
We operate 4 locations in the Pikes Peak region and 40 locations overall in Colorado. We're part of a bigger bank named NBH Bank, and our division of that bank, and continue to look for ways to grow. Our role in the community is really focused on being first a relationship-oriented bank and an advisor to our clients. And I know a lot of banks talk about what relationship is, but for us, relationship means that we're not there for the singular transaction. We're there to help that client, that business, that consumer to build whatever their financial plan is, whatever their growth model is, and to deliver that experience in a way that helps them understand both the risks and the opportunities of their approach to that. And that, we think, makes us a little bit unique in that space. That calculated approach, I think, is also very welcoming because people know what they expect and what to expect from our teams.
Absolutely. So it's been an interesting week or two. What insights can you give us on the recent events in the banking industry?
Yeah, it's certainly been interesting on a lot of different fronts in the market, and specifically around financial institutions and banks. Most daily right now, we're seeing a lot of different volatility related to news coming out. And there is a lot of news. And with any news, it's postured in certain ways. It can be good information, or it can be misinformation or misconstrued information. So we do see that. But overall, we know that it is challenging for consumers and businesses to know how to respond during times like this. And before I dive into any other components, I would just say that, what's contributing to some of this, I think, is important to go back and look at. And Joe, you as professor of economics understand what some of the importance of this is, that a lot of this really started back when we had COVID, and we had a lot of stimulus dollars pumped into our overall economy to the tune of over $3 trillion. And that was direct stimulus. In addition, you had the Federal Reserve posturing interest rates in a very favorable mode or a very favorable position during that time. And those rates, combined with that economic stimulus, created this large amount of inflation. Of course, late last year, the Federal Reserve really said, we've got to take control of this inflation, and we've got to reverse these interest rates to the point that it takes the inflation out of the system. So you've got 2 episodes in a very short period of time where you've had economic adjustments to interest rates, both downward and now upward in the overall economy. And that adjustment has created just an immense amount of volatility in the banking sector. So clearly there's a lot of risk that can be borne with that. There's a lot of opportunity that can be borne with that. But make no mistake that the overall economy has been impacted by those rate adjustments. So some of what we've seen over the last week are a culmination of some of those drastic impacts and dramatic measures that occur when those impacts are in place. It was only, a year and a half ago, and you could probably point to a good number of financial institutions that were offering 15-year fixed rate loans at 2 to 2.5% in a mortgage. And today they are offering a 5% CD for 12 to 15 months. I think anybody that knows some basic math knows that doesn't work that well. And so the discipline required and the oversight required in banking today, I would say, just due to the extremes, is as heightened as it has ever been. So I would say that that's a little bit of insight around what we're seeing overall in the industry today. You can go into a lot of different aspects of this. You can talk about the word contagion today, which is simply what's the impact of the effect of one or a small group of banks on the overall banking industry. That contagion can spread out into, the business environment, the consumer environment as well. So we see that as being one of the main components that's creating some risk and just some a lot of speak in the marketplace right now. But I think overall, some other insights that we've seen and that we always are on the lookout for, and any business should be on the lookout for, is concentration risk. You hear that word a lot, but simply put, if you've got two clients that contribute 80% of your overall business plan or your business growth or client base, and something happens to one of those two clients, it can have a dramatic impact. And banking is no different than any other business or any other, whether you're stock investing or anything else. You don't put all your eggs in that one basket. But when you've got exposures to market segments or business segments in banking that are in excess of other areas, that lack of diversification can expose you to risk. And so you do see that from time to time, and during the current environment, I think we've certainly seen that. The other thing that you've heard about or read about is what's called duration risk. And I kind of referenced that early on, where you're pairing up a long-term loan with a short-term funding asset. And when the rates change and your funding structure changes, if not properly managed, that can really result in some drastic events. And one of the things, and I can get way more technical here than I think anybody would want to hear.
Other than me, of course.
Other than you, of course.
Yeah.
I mean, there are certainly those of us who love the detail and the numbers. But at a high level, I think one of the things you see is that duration risk plays out because their pricing has to change so quickly. And again, it's a byproduct of the interest rate environment, but it's also a byproduct of how quickly, an organization, and again, not speaking specifically to banking, but that an organization in general may have grown. An organization that grows 300 or 400% in a 2 or 3 year period may have grown that way for a lot of very good reasons, but there may be a lot of unknown consequences behind that until the market or the environment shifts, you don't realize. So I know that's a lot of information, not just banking, business in general, but it certainly correlates to what I think we've seen in the last couple of weeks.
Absolutely, and I loved it. You're great at explaining this at a very good level for our viewers. So, So I've had a couple requests for interviews the last couple of days. So they're always asking, what do you tell consumers? So I'd love to hear it from your mouth, because I have my own spin on it. Mostly, don't panic. But
sure, yeah. Panic is obviously not good in any regard. But from a banking perspective, know your bank and know your banker. Mm-hmm. Sometimes, the old-fashioned relationship can be lost. And in times like this, not kind of understanding that, having that professional in your Rolodex, so to speak, using an old term, or in your cell phone contacts, if you're using more current terms, is really important. And the expertise that they can bring is critical. We see right now that there's a lot of confusion around, say, FDIC insurance. Obviously the FDIC insures depositors up to $250,000. But what may not be common and may not be present when people talk to their bank, hopefully it's our bank, but they may not understand that there are ways to structure their deposits, and especially in the personal space, to cover well in excess of $250,000. So they could have $1.5 million of coverage under the right structure. And again, their banker or their bank would be able to help them position that. For businesses and larger depositors, there's some services that banks like ours offer that they can spread that around and maintain full insurance coverage. But we've got to, work with the clients and enroll them in those services. So I think there's some good opportunities out there. But if you've got questions, be sure to ask them. I've always heard the old saying that there is no such thing as a bad question unless it's unasked. And so the bad questions are the ones that aren't asked, so that you are doing your own personal diligence.
I love that. I'm going to add that into my lexicon when I tell my students. So. All right.
There
so, yeah. So what challenges do you see for yourself in banking in our community in the near future, as it stands and in light of recent events?
Yeah, I think that's it's always a good question, and you're an economist, so you always can afford to be wrong part of the time because eventually you'll be right.
Mhm.
If I actually had the crystal ball and was right, I would certainly be in some position that hasn't been created yet because nobody knows for sure. But looking at what I can see is one, speaking more to the Pikes Peak region, we are a resilient economy. We've been resilient. We've cycled through a lot of different economic challenges. And while we don't know yet the extent of any economic impacts that may happen here with these recent events and kind of the Fed moving the interest rate policy, what I can say is that our local economy will be resilient and will be a survivor. What that looks like, again, is anybody's guess. But the other component, and this is tied to banking in general, is when you have large interest rate movements and then you have perceived risk, overall, the economy as a whole has that embedded risk causes people to take positions to help protect that risk. If it's in banking, it could be tightened lending standards. That's been a common theme here as you've listened to any of the commentary around the current environment. But what you get concerned about is how deep does that go and what is the impact on certain economic areas? Because at the end of the day, it contracts expansion. And it's a byproduct, again, going back to what the Fed has been working on. They are trying to contract expansion. They're working on what they call a soft landing. But anytime you start to interject more risk into the environment, you can change the story of that. And so I see that being one of the biggest challenges for our community, banking as a whole. And I think we all continue to monitor it, watch it, and be smart about how we position ourselves, regardless of what business or what industry we're in. We just everybody's got to take a calculated approach to how they want to invest their funds and position their returns. So I think that would be my thought on that.
Well, thank you so much, Brendan. It's been a pleasure talking to you. Again, this was Jim Craig with the UCCS Economic Forum and our weekly snapshot. If you have ideas for the future, please let us know. Thanks, Brendan.